Good afternoon, everybody. This is Chuck Hughes. Welcome to our continuing series of webinars for Inner Circle members to discuss current market conditions and the strategies that we're using in the Inner Circle Advisory Service. Today I wanted to talk about the option rollovers we have coming up for the Inner Circle Advisory. This month and next month we have a total of 27 option rollovers. So we're going to discuss that a little bit today. And I have three stocks that I think we should focus on these rollovers because they're on a what I call a high probability buy signal. So once I send out an email with the rollovers, I suggest you take a look at these three stocks we're going to look at and roll those over if you currently own the options, and if you don't and you're a newer member, then certainly consider purchasing the options for these three stocks that we're going to discuss today. So the option rollovers have been working out real well for us. We roll over option trades that still meet our prime trade selection criteria. And when we roll over an option, it reduces the cost basis of the new option and, of course, reduces risk. And it allows us to compound our returns. So if the option that we're rolling over still meets our trade selection process, then we'll go ahead and roll the option over rather than close it out. And that's been working out real well for us, and that's enabled us to achieve high returns in all of the option portfolios, the option purchase, the option spreads, and the buy right portfolios. We've been rolling those positions over for the last year or so, and as a result, we have very high average returns in these portfolios. So we use a three-step trade selection process, and I take a look at the stock for an option that's expiring, and if it meets our criteria, then we normally will go ahead and roll over the option. But step one is we use the trend following systems to determine the price trend. Step two is we want to confirm the price trend, and then step three is we want to use the Keltner channels to determine an entry point. And step three would apply for new positions, not necessarily for rolling over options. And we also use fundamental screening, and this has given us a real edge this year. We look for stocks that have high growth in equity, retained earnings, revenue, and dividend. And this fundamental analysis this year has enabled us to select stocks that are far outperforming the market, and it can give you a real edge in this type of market. And our basic trend following system is the 50 and 100-day EMA system. And when the 50-day exponential moving average for a stock is above the 100-day exponential moving average, that stock's on a buy. And if the 50-day EMA is below the 100-day EMA, the stock is on a sell. And if the stock is on a buy, then we want to buy stocks, call options, and call option spreads. And if the stock is in a price downtrend, we want to buy bearish ETFs, put options, and put option spreads. And here's an example of a 50 and 100-day EMA buy signal. And we can see the 50-day EMA, which is this blue line, crossed above the 100-day EMA, which is the red line. So when that 50-day crossed above the 100-day, this price chart's for Apple. then Apple stock was on a buy, and then we want to look at buying the stock and buying call options and option spreads whenever a stock is on a buy signal. And we can see that the blue line here in this example stayed above the red line. So as long as that the 50-day is above the 100-day EMA, then Apple stock is on a buy, and we'll look to taking long positions whenever a stock is on a buy signal. Here's an example of a sell signal. This was Merck stock, and we can see right here the 50-day EMA crossed below the 100-day EMA, and Merck stock was on a sell signal at that point, so we only want to take bearish positions once a stock is on a sell signal. And we don't want to buy the stock until the 50-day EMA crosses above the 100-day EMA, because you don't know how long this downturn is going to last or how severe it's going to be. So we just simply wait for our system to tell us when to buy and sell. And our bullish trades fall into several categories. When a stock is on a buy signal, we'll purchase the stock or ETF. We purchase call options, and we also purchase bullish option spreads. And if a stock is on a sell signal, then we want to take bearish trades. We'll purchase put options. We'll purchase bearish option spreads and bearish ETFs. Now let's look at a couple of recent examples of the 50-day EMA and 100-day EMA. These are options that we have in our inner circle portfolios. This is for Philip Morris. This was as of yesterday, and we can see the 50-day EMA is above the 100-day EMA, so Philip Morris remains on a buy signal. And that's one of the options we're rolling over this month and next month. Here's another example of an option position we have. This is for U.S. Bancorp. And again, the 50-day EMA is above this, the red line, which is the 100-day EMA. So USB remains on a buy signal, and we'll be rolling over our options in USB. And here's another example, Apple. And again, this is the daily stock price here, and we can see the 50-day above the 100-day EMA, so Apple remains on a buy signal. And this year, you want to avoid growth stocks with high PE ratios. These growth stocks have been getting crushed in this slow-growing world economies, both here in the U.S. and overseas. These slow-growing economies are more suited to blue-chip defensive-type stocks this year. So these growth stocks with high PEs have been getting crushed this year. Here's a price chart for Research in Motion, and you can see the 50-day EMA below the 100-day EMA, so that's obviously on a sell signal. And here's another example, C-Trip, First Solar, and Deckers. So here's one more Acme Packet. So these stocks, these growth type stocks, have been getting crushed this year in slow-growing world economies. And it's simple to download this 50 and 100-day EMA lines. You can just log on to stockcharts.com, type in the stock symbol, and select daily for periods, and I usually select a 1-year price range. And then under overlays, you simply select exponential moving average, and then the parameter would be 50, and then select exponential moving average again, and parameter 100, and that'll display the 50 and 100-day EMA lines, and that gives you an instant picture of a stock. It only takes a few seconds to do this, but it gives you an instant picture of whether you should be buying or selling that stock or option. And we also use the major trend system. This is a little longer term, but I like to check these on my stock positions whenever I'm going to take a position or exit. I like to know where this major trend system is. And this system is particularly useful if we're going to be taking short positions, because it can help prevent whipsaw trades when you go short and then have a counter trend rally. If you go short when both the 50-day and 100-day EMA is on a sell signal and the major trend system is also on a sell signal, then you have a much higher probability of that short trade being profitable. So it's very useful when taking short trades also. So with the major trend system, we look at the 1-month price in relation to the 20-month EMA. So again, this is a longer-term picture of the stock. And when that 1-month price is above the 20-month EMA, the stock is on a buy signal. And if the 1-month price is below the 20-month EMA, the stock is on a sell signal. And here's an example of the S&P 500 index with the 1-month price right here, and the blue line is the 20-month EMA. So as long as that 1-month price is above the 20-month EMA, then the stock is on a buy signal. Once that 1-month price crosses below the 20-month EMA, then the stock is on a sell signal. And this time frame here was the S&P, and you can see it caught the move from the bullish move from 2003 up until the end of 2007. And once this 1-month price crossed below the 20-month EMA, that was in December of 2007, then the system was on a sell signal. And of course, at that point, we didn't know how far the S&P was going to go down, but it went down pretty far. So it just shows you the usefulness of using a trend-following system when you're trying to trade. Instead of trying to predict where a market's going to be, it's much better to just simply follow the trend. And we do that with the 50 and 100-day EMA and the major trend system. And this is a longer-term chart for the S&P, and you can see the major trend system caught most of the up move in the 1990s. It went on a sell signal in 2000, was on the short side during that severe bear market, went bullish again in 2003, and went bearish again at the end of 2007. So it's been catching the up moves and down moves in the S&P pretty well. Here's just a few examples of the major trend system current readings as of yesterday. This is for Apple, and you can see the 1-month price here is above the 20-month EMA, so Apple remains on a buy signal with the major trend system. Here's a graph for Ross Stores. That's another option that we own. And Philip Morris. So our 3-step prime trade select process is we determine the price trend, step 1, and then once we determine the price trend, then we want to confirm it. And then step 3 is to select an entry point using the Keltner channels. And step 2 is to confirm the price trend. And at any given time, there could be hundreds of stocks that are in a price uptrend. So the trend confirmation indicators that we use can help us narrow down that list of stocks to the stocks with the best profit potential. And we use on balance volume, the new 52-week high list, and we also check the industry grouping for a stock. So these three indicators confirm the price trend, and they help us narrow down that list to the stocks with the best profit potential. And to measure the volume, I like to look at the on-balance volume line, and that simply measures the volume flow. And the volume flow usually precedes the price, and it's the key to measuring the validity and sustainability of a price trend. So I like to look at this indicator to confirm either a price uptrend or a price downtrend. And with the on-balance volume line, pretty simple indicator. When the close is up for a stock, if a stock closes up for the day, then volume is added to the line. And when the stock closes down, volume is subtracted from the line. So a cumulative total of these additions and subtractions form the OBV line. And here's an example. This is for Sherwin-Williams. Here's the daily price action, obviously in an uptrend. And in this lower chart, we have the on-balance volume line. That's this line right here. And you can see the on-balance volume line is sloping up, and it confirms this price uptrend for Sherwin-Williams. And with the on-balance volume line, the numerical value of this line really isn't that important. You simply want to see this line sloping up to confirm the price uptrend. So with Sherwin-Williams, you can see last November, the 50-day EMA crossed above the 100-day EMA. So at that point, the stock was on a buy signal, and that was also confirmed with the on-balance volume line sloping up. So we have a confirmed price uptrend for Sherwin-Williams. So an upsloping on-balance volume line indicates that the volume is heavier on days that a stock is closing up and buying pressure is exceeding selling pressure. And that buying pressure must continue to exceed the selling pressure in order to sustain that price uptrend. So this is a very valuable tool that helps, the volume flow helps sustain this price uptrend. So this is a great way to confirm the price uptrend. And we also use the new 52-week high list to confirm the price trend. And in my experience, I found that these stocks that continue to make that 52 new week high list on a regular basis tend to continue their price uptrend. And usually if they make that 52-week high list, then they're in a very powerful price uptrend. So this is actually a great place to start your trade selection by simply looking at the new 52-week high list, because you know all the stocks in that list are going to be in very strong price uptrends in order to make that list. So that's a great place to start your trade selection. And, a stock will not make this new 52-week high list unless it's in a very powerful price uptrend. So this is a great way to confirm the price trend. And here's another price graph for Sherwin-Williams. We can see it's been making a series of new 52-week highs here, and we have that upsloping on-balance volume line confirming this price uptrend. And it's easy to download this new 52-week high list. Also, you just go to barchart.com and click stocks, and then on the left column, just select 52-week highs, and that'll give you a list of the stocks that are making a new 52-week high that day. And I also like to check the industry grouping, and you can do that by either checking this new 52-week high list on a regular basis and just get a feel for which industries are outperforming, or you can simply look in the Monday edition of IBD and they list the relative strength of the various industries. So I like to pick one stock, usually from each industry, to help diversify my portfolio. And quantitative research has shown that approximately 1/2 of a stock's price appreciation is due to the industry grouping of the stock. So you like to focus on these industry groups that are performing well on a relative basis, and that can also help select stocks with the best profit potential, because most of the stocks in that industry grouping, if it's a strong industry, will be going up in price. And here's a few more examples of trend confirmation. This is per TJX. We have options on this stock, and you can see TJX making a series of new 52-week highs. You can see the 50-day EMA above the 100-day EMA, and this price uptrend is confirmed by the on-balance volume line, which you can see has been steadily sloping up. Here's a trend confirmation example for Sherwin-Williams, PPG, and Colgate-Palmolive. So those are just examples of our trade selection process. And here's one more example. This is for Philip Morris. We have options on Philip Morris in our accounts that we'll be rolling over. So step 3 of our trade selection process is using the Keltner channels to help us find a good entry point for our stock or option position. And just briefly, the Keltner channels act as an overbought, oversold indicator, and there's 3 channels. This the top line here is the upper channel. The dotted line in the middle is the middle channel, and this line, the line below here is the lower channel. And here's the daily price action. This is for a price chart for Apple stock. So this is the daily price action. So we like to use the Keltner channels to help us find a good entry point. And it's a very simple indicator, but very useful. When a stock is trading near this upper channel, or if it's trading above the upper channel, the stock's getting overbought, and usually it will correct down to the middle or lower channel once it becomes overbought. So you can see the price movement here. Apple stock got above this upper channel, got overbought, and then it retraced back down to the middle channel and closer to the lower channel. Again, got overbought, retraced, overbought, retraced. So you can see that the Keltner channel is very useful for helping you select an entry point. And the center line, the middle channel here, is the 20-day EMA average for the stock. So this middle channel is the 20-day EMA. And the upper and lower channels is calculated by taking the average true range, multiplying it by 2, and that's how the upper and lower channels are drawn. So it's the average true range of the past 10 days, and you simply multiply by 2 for the upper and lower channels. So we want to be buying when the stock is trading near the middle or lower channel, and we don't want to be buying when the stock is trading up near the upper channel or above the upper channel. And again, you can see This is another price chart for Apple, and you can see each time that Apple stock traded above that upper channel, it did retrace. So whenever a very simple indicator that indicates a stock that's getting overbought, and you don't want to buy when it's overbought. You want to buy and get a lower risk entry when it's trading near this middle or lower channel. And what I did in this price chart here is I circled the days that I purchased Apple stock. I was using these Keltner channels to help time my entry into Apple stock. And these are brokerage confirmations. And in this first one here, I bought 400 shares of Apple at 193, 100 shares at 197, 400 shares at 203. So I was dollar cost averaging, but I used these Keltner channels, and what I did was I didn't buy when Apple was trading up here above the channel, the upper channel. I waited till it retraced back towards the middle or lower channel, and then I bought. And you can see these are the days, these three circles are these days up here that I bought Apple stock. And you can see that the Keltner channels gave me a very low risk entry, because after my entry, Apple stock really didn't retrace very much. So it gives you a lower risk entry, and when you use these Keltner channels, you have a much higher probability of a successful trade. And I've been using these Keltner channels now for many years, and I noticed that when the price of the stock, if it actually closes below this lower channel, it's becoming very oversold. And stocks that are in a price uptrend but become temporarily oversold, and if they actually cross below this lower channel, that's what I call a high probability buy signal, because that usually sets up for a very powerful rally. And it doesn't occur very often, but we have three recent high probability signals on options that we're going to be rolling over here. So I wanted to just point those out to you today, so that when the rollover orders come out, you can take a look at the rollovers, and if you don't have the existing option, then consider purchasing it, the new option when we roll over. And these high probability signals have been working very well for us. And here's an example. This is for Baidu. You can see the stock's in a price uptrend, but becomes temporarily oversold, and then the stock actually closed below that lower channel. And that usually sets up a very powerful rally. So my brokerage confirmation shows that I bought 200 shares of Baidu right here as soon as it closed below that lower channel at around $98. And again, these high probability signals usually last anywhere from 6 to 8 months or longer. They don't occur that often, but usually it sets up for a very powerful rally when this oversold condition occurs in the context of the stock being in a price uptrend. Here's another example. This is for Chevron. Stock actually closed below the lower Keltner channel here, and then it went on a very powerful rally, 45% rally from this point, and that's a pretty big rally for a blue chip stock. Here's Caterpillar, high probability buy signal down here in February, and it went on and had a 85% rally from this oversold condition. Here's Tesoro, 72% rally from this oversold condition. And here's another example. This is for Apple, and you can see right here, the stock's in a price uptrend, becomes temporarily oversold right here. So I went ahead and bought 200 shares at around the 333 price range, and that set up a very strong rally. And here's my current stock portfolio. I have two accounts where I trade stocks, and I use this Prime Trade Select selection process to select these stocks. So I currently have $352,000 in open trade profits for these two portfolios, and I have an average return of 42%. So this is real-time results for our trade selection process. In this account, I have a $221,000 profit. And this is a snapshot of our current open trade profits for the inner circle, and we use our Prime Trade Select three-step selection process to select these stocks. And you can see we currently have open profits of $201,000, average return of 107%. So, and all the trades are profitable. So our Prime Trade Select is working well in helping us find stocks with good profit potential. And here's the small and micro cap portfolio. That's been performing well lately. We currently have $151,000 open trade profit and average return of 111%. And in these portfolios, of course, we had a big rally today, so the results will be even better once the prices update. And the prices update on the inner circle portfolios every day at 5 o'clock Eastern time. So each day, both the stock and the option prices update, so you get a daily picture of how each stock and option position is doing and how the portfolio as a whole is doing. And here's the current results for our option purchase portfolio. We currently have $247,000 open trade profit, average return of 395%. So that's a pretty high return, average return for this portfolio. And part of this return is due to the rollovers that we do periodically. And now let's focus on three stocks. Now these are coming up in our rollovers, and I just wanted to point out that these three stocks recently had a high probability signal. So you want to take a look at these when we're rolling them over, and if you don't already own the option, consider purchasing the new option. And this first price chart is for Apple, and I calculated the last 5 of these high probability signals produced an average return of 81.1%, and the average period was 8.2 months. So once we get these high probability signals, the last 5 have produced an average return or an average rally of 81.1%, and that was over an average 8.2 month period. So the current buy signal for Apple has a 17.5% return. So we could have a longer, we could have more profits on this current signal based on this average return of 81% for the last 5 signals. So at 17.5%, we have a ways to go with this high probability signal. So I just wanted to point that out because we have Apple option rollovers next month and option spreads. And here's another one we have that we're rolling over. It's Philip Morris. And again, you can see when Philip Morris became oversold and closed below that lower channel, it sets up a good rally opportunity. So we recently had a high probability signal back in June for Philip Morris. So that's had a recent high probability signal. And the third one is U.S. Bank Corp. And again, you can see that these high probability signals set up really powerful rallies. So that concludes my presentation for today, so I'd be glad to take any questions.
Chuck, there are a number of questions. If you could check the chat section, and we have a couple of questions in the Q&A sections that I'm going to add there as well.
Okay, good. Okay, it says, Chuck, once you roll over an option and lower your cost basis, can you discuss how you manage your stop? For example, 25 to 30% loss. And normally we use a money management principle to cut our losses in an option. If we purchase an option and it drops 25 to 35% below our entry point, then we normally will simply exit that trade because we don't want that to develop into even a bigger loss. So with stocks, we use 10 to 15%. Options are more highly leveraged. So if we buy an option, we normally will exit if it drops 25 to 35% below our entry point. Now, on the rollovers, that reduces our cost basis. So on the rollovers, we normally don't get stopped out. But if you're doing the rollover and you don't own the existing option and you're purchasing it at the current price, then I recommend you use a 25 to 35% stop from your entry price to exit the position. So if you're just getting into the option on the rollover and you don't own the option that's expiring, then you want to exit that position if the option drops 25 to 35% below your entry point. Okay, and here's a question on your recent trade rollover recommendations. You have recommended buying spreads on Apple and GLD when the prices of the stock or ETF was trading at or above the Keltner channel line. Yeah, that's a good question. We use the Keltner channels for our initial entry. Now, if we're rolling over an option and it's trading near that upper channel near rollover, then we don't really have a choice, because if we're going to roll over before it expires, we have to roll it over. So we use the Keltner channels more for our initial entry and not for the rollovers, because we have a time constraint, and when we're getting close to expiration, you don't really have a choice. If you're going to roll the option over, you have to roll it over regardless of where it is in relation to the Keltner channels. Okay, here's a question. Are the three high probability stocks USB, Philip Morris, and Apple? Yes. Those are the three stocks that I wanted to point out today that we're rolling over options on those three stocks soon, so I just wanted to point that out to you. But they are the three high probability signals. Okay, here's a question from Joseph. Thinkorswim has an ATR Wilder indication. Is that what you mean by ATR? I'm not really familiar with the ATR Wilder indicator, so I don't really know what that is. Okay, let's see if there's any other questions. Okay, it says, do you use the Keltner channels in reverse for sell signals? Yes, we use the Keltner channels for sell signals. Now, we currently don't have any short positions, but there will be times when we have short positions. And the inner circle was heavily short during the last bear market. We went short in the spring and summer of 2008, and we stayed short until March of 2009. So we had mostly all short positions during that time period because the major trend was down on most world markets. So when we do establish short positions, yes, you can use the Keltner channels, and I have used them, and you want to wait till the stock gets overbought before you take the short signal. It says here, if I don't currently own monthly options, should I wait until it is below the Keltner channel? Does the stockcharts.com have the Keltner channel analysis? Yes, they do have it. And yes, you could, if you're looking to enter a new option position, yeah, you could wait till the Keltner channel for the stock is trading towards the middle channel or the lower channel to give you a lower risk entry. Okay, here's a question. This is for our married put portfolio for Duke, D-U-K, and it says it's currently trading about $64 a share, and we have a January 2014 15 put. Why is it so far out of the money? That's a great question. And what happened was Duke had a reverse stock split after we put on this married put position. So the stock was a lot higher than after this reverse split. The stock price was a lot higher than it was when we first entered that position. So what they did was they adjusted that the 15 strike put. That was adjusted for the reverse split, so that that 15 put actually has a higher value than 15. So the only way they can do that is they adjust the option, and that is an adjusted option. So that's why Duke is trading at $64, and we currently have the 15 strike put. When we first bought that put, Duke was trading around that strike price. So after that reverse split, then they had to adjust that 15 strike put. So that is an adjusted option. Okay, and here's, let's see. Okay, it says on the open trade profits, what is the time frame? That time frame is going to vary, obviously, with each portfolio. But if you look at our entry date, you know, the top table has the date that we entered the option or stock position. So if you look at that entry date, that'll give you an idea of the time frame that the open trade profits are based on. Okay, here's another question. What is the Apple ATR today? Just as a reference, and I'm sorry, I don't know what ATR is, so I can't answer that question. So, okay, I think I've answered all the questions. I want to thank everybody for attending today, and we look forward to our next webinar next month. Have a great day, everybody.